So Gareth, I consider you as a true expert on hedge funds. Thank you very much for being here today. I appreciate it.
Good afternoon, everyone. Thanks for the opportunity to talk on hedge. The analogy is travel today for our hedge fund journey, and I think it resonates in two ways. It's number one, I think as an advisors or representing retail assets, it's a journey to eventually invest in hedge. I think there's no doubt that there's obviously been a lot more airtime given to traditional long-only portfolios and multi-asset portfolios. And thanks to FundRock and BCI, it really is exciting for us to be able to speak more and more about hedge. The second really is our journey, and I think a lot of times we can learn from other people. We've been doing hedge funds for a long time, and hopefully some of the small anecdotes can assist you in how to consider putting hedge funds as a building block into your portfolios. So our journey started 24 years ago. Our flagship hedge fund, which we're going to touch on later, Corion Absolute, has been running for 24 years. So we have been doing this for a long period of time. And really, your journey to hedge or why you would invest in hedge funds starts with a couple of simple elements and metrics which you hope to fulfill. Firstly is you want differentiated return streams. You don't want to be getting returns from the same drivers that you're going to get from your traditional asset classes, equities or bonds. So you're looking for something differentiated. You're also looking to get those returns, hopefully in a better risk-adjusted manner. I think one of the benefits that really resonates for us when constructing portfolios is the fact that we can dampen volatility or drawdowns through hedge funds. And then lastly, ultimately, is capital protection. Now, I think hedge funds across the world, there's this homogenous term for hedge funds. And you've got these Wall Street type hedge funds that can make 200% a year and lose 50% a year. That's not the SA hedge fund industry. We've got a very well-established, highly regulated industry. And, the evidence is irrefutable. If you go and actually look at our hedge fund return data and look at some of the brilliant managers that we've got in South Africa, there's definitely a protection of capital during market dislocations. So in terms of our team, we've got a very focused hedge fund team. David at the top left has been CIO of Corion since 2008. He cut his teeth in the hedge fund industry, been in the industry since 2001. I've been in the hedge fund industry since 2007. Simon was David's first hire when he took over at Corion in 2008. Again, built risk systems around hedge fund. Anthony, often people say, don't be fooled by the grey hair. In Ant's case, he is that old and he has been doing hedge funds for a long time. Our team is hedge fund focused and well established. But we are supported by our broader investment team because hedge funds isn't just about some unique outsourced or outsized trades. It's also about your traditional asset allocation, manager research. So we built a team that is fit for purpose. But importantly, is that we've got such a good hedge fund industry in South Africa that it can be well researched and we've got value to add. So in terms of hedge fund investing and just general market investment, you've got different modes of investment transport. So first of all, the ETF bus. I did take note that there were no passive houses here this morning, but an ETF is an interesting vehicle. It's cheap, it's uncomfortable at times, but you'll get there in the end. We love passive. We think it's a big part of portfolios, but ultimately there's too much focus in our view on fees and what you're getting from your returns. The next is the active manager, which we also very much ascribe to. The fact that we believe in hedge will tell you how much we believe in the skill of active managers that we invest with. And yes, we get good managers who can do more, but ultimately one of the problems, constraints with active management versus passive is that they aren't the same road. They're constrained by the same markets, same mandates. So you are limited in how much you can differentiate yourself over a period of time. With hedge funds, however, one of the big perks of being a hedge fund is you are less constrained. We are able to do things in, source returns in a different way, but also we're not bound to be invested with the same strict equity mandates that your equity managers would have and have to be invested all of the time in an equity mandate or bound by Reg 28. A hedge fund gives you the ability to do things at different times, to flex, how much direction exposure you've got in the market. If hedge fund managers are bullish, you give more exposure to the market and vice versa. When it comes to actual hedge fund managers, the same way in the normal traditional active world is, not all managers are exactly the same. Managers come from different backgrounds, different educational backgrounds. They see the world differently, different understanding and styles, different risk appetite. So for us, it's very important to make sure that even in the hedge fund space, don't see hedge fund as just one only type of manager. Within the hedge fund management space, there are very differentiated egos, styles, and education elements. And I think, our simple message is you don't want to plan a fantastic holiday, go to one place, and it was absolutely crap. You hopefully can differentiate a bit more with a diverse choice of hedge fund managers. Equating it to climate and the same thing. You don't want to be in a position where you choose a great destination to go snow skiing, but you rock up in summer. There are different hedge fund strategies for different types of the market. The long short managers are going to give you a bit more beta, a bit more exposure to the market itself. Fixed income managers, specifically focused around the fixed income hedge in South Africa. We've got some unbelievable managers that play both sides of the curve, long and short. Then you've got market neutral, potentially more defensive. Markets are really high, valuations really stretched. Maybe market neutral is a strategy that is more attuned to that current environment. And then you've got the multi-strat, which ultimately gives you a bit of both worlds. It gives you a lot more defined payoff profile than you would get from a single manager. But once you've got all of that right, I think one of the realities is that, we termed it here climate change. The reality, we're seeing it more and more. But even if you've picked the right strategy, the right time, the right destination, sometimes things can go wrong. And it's also important to notice is when you are investing in hedge funds, because people are not only long only, you can get a difference and dispersion in return profiles. So what we've shown here is two of South Africa's best fixed income hedge fund managers. These are their actual returns. As you can see, they've done exceptionally well for a period of time. And I think also with hedge funds, it's not just to look at returns, it's how you deliver the returns, which we'll touch on. But you can see great returns, brilliant managers. But if you take a step closer, you can see how big relative return dispersions can be at any point in time. But it's just something to be mindful of, to know that we don't believe that it's just one size fits all when it comes to hedge fund investing. And even within certain styles or certain asset classes, you can get a variance. It's probably a bit more of a dispersion than you would get in the long only space. And lastly, when it comes to hedge funds, a lot is made of the cost. The truth is they are more expensive. If you look at the spectrum of passive versus active, passive being the cheapest, then active, this is your ultimate form of active. You should only pay for hedge fund managers that are going to deliver returns. But we believe it is 100% worth the bang for the buck. Sometimes things are more expensive. To protect capital, to give a diversified return focus, we think is worth the spend. So what does this all in a snapshot mean and the experience? And I think we're going to refer to two of our funds here, but I really want to make this point, is that our funds, being multi-manager, multi-strategy, invest in the likes of some of the managers that you've seen today. We are blessed with brilliant hedge fund managers in South Africa. The only way we can show the returns that we have in the portfolios we constructed, because we've got great strategies and managers to invest with. So going into Absolute, in November, Absolute turns 24. These are the actual track records. Absolute is a multi-strategy fixed income alternative. Again, it's also very important to make sure that you know what type of return profile you're expecting. This fund is not there to outperform equities. It's not there to do anything other than be a fixed income alternative, but at a better risk-adjusted return. What do we mean by that? Lower drawdowns, so less capital loss during market dislocations, and less volatility in returns. This is critical when it comes to retirement and living annuities, where there is risk and real liquidity risk at certain events. So this is what this fund was designed to do. And as you can see, through its life cycle, through many periods, it's delivered, returns in excess of bonds, except for, which we're all aware of, the last 3 years, and specifically the last year, where we've had this unbelievable bull run in bonds. But the most important part is, what does it mean and how do we capture these returns? So what we've shown here is two elements, a bull market capture and a bear market capture. A bull market capture meaning when a market or asset class is up, what does this fund manage to do? And when it falls, what has it done? So here we can see the bull markets. This is against bonds. So when bonds have been up since the inception, 23 years, on a monthly basis, they're up on average 1.8%. This fund's captured approximately 60% of that. It's up on average 1% when the market. However, over a rolling 12-month period, it's captured the full upside of bonds. And over a 3-year rolling period, it's actually it's captured more than the returns of bonds. But on the bear market side now, when bond markets have been down, on average, they're down 1.5%. This fund has actually got a negative capture. It's delivered positive returns. And also on a rolling 12-month period, when it's on average been down, it's been down on average 2.7%. This fund's actually delivered 5.6%. So inversely and asymmetrical is what you want, is that you can capture upside when markets are falling and protecting capital and managing to participate in returns. What you'll see there's no 3-year rolling period where bonds have been down. So the nature of the asset class. Into our next fund, which is what we call a Corion multi-strat. This has got more equity and more typical long-short exposure and managers. This fund has been running for 10 years, and we're measuring here against its benchmark, which is 50% equities and 50% STEFI. Again, outperformed across all time frames. We're very proud of this track record. Again, no coincidence because we've got really good underlying hedge fund managers. But look at the bull market. So when the market's been up over this period, for the 10 years since its inception, the benchmark's been up. So it's the 50% cash, 50% equity benchmark. It's up on average 1.9%. Multi-strats captured nearly all of that, 86%. When it's been up over a 12-month period, captured more than that. It's at 114% of that capture. And over a 3-year rolling period, 120% of that capture. Again, on the bear market side, when markets have been down, they've been down on average 1.3. We've been down half that. And when it's been down over a 12-month rolling period, minus 2.7%, we've basically been flat through that period. So you're participating on the upside and protecting on the downside. And lastly, I think this is probably the most telling and most important, because what we're looking at here is, there we looked at protection of capital really during downturns. Here what we're looking at is risk from a volatility perspective. How have you managed to deliver the returns in your portfolio? What element of risk are you taking from a vol, a variability perspective? So as you can see there, we've got the ALSI and we've got the ORBI. We've obviously had incredible returns from an asset class perspective, and you can see that on the x-axis, that is your risk side. You can see that the ALSI's done those returns at just under 14% during this period, but it's delivered returns of around 11%. But now put in the multi-asset CISA category averages. So this is your low, medium, and high equity portfolios. So your high equity is your typical growth portfolio. So what you can see during this period is they've been, high equity is obviously less than the ALSI from a risk perspective. It's had subdued returns. There are explanations with NASHFAS being a big part of our market during this period. But bottom line is that your CISA high, medium, and low equity are sitting almost below the fishing frontier, if you will, here. But if you put our hedge funds against this, not only are we outperforming your low, medium, and high equity returns, we're doing it at low risk. So hedge funds, in our view, need to be considered. Whether they are for everyone, that's going to be up to the advisor, up to the retail investor to make the decision. But it is a very difficult concept not to consider them when we've got the regulatory capital that has been invested in the hedge fund industry in South Africa. We've got very talented managers, and we are producing these types of returns, but at a very, very palatable risk. So onto the advisor. I mean, ultimately, we think the advisor plays a critical role. I was actually chatting to Mark earlier. We've got one of our clients was moaning the other day because equity markets are up 18% and our funds haven't participated as much. That's why we've got beta in our portfolio. That's why the majority of your portfolios are going to have equity. You're going to have fixed income. This is a building block to differentiate. It's never going to be the lion's share of your portfolio. So as an advisor and participants representing the retail market, it's important to know what is the purpose of a hedge fund in your portfolio. So you can bring it in for stability, to reduce correlations, just to basically dampen the experience. You can also look at it as a return enhancer. There are very aggressive hedge funds in South Africa. We got two regimes. We've got a retail investor hedge fund regime and qualified investor, QIFs, RIFs and QIFs. You can get return enhancement, but ultimately it's up to the suitability of the advisor in terms of what they're putting it in and making clients aware of why they have got the hedge funds. And that's it. I've got us.
Yeah, thank you so much. We see a lot of experts on hedge funds. I've read from advisors. We've covered a lot of this in, I think, what our first session were how they're regulated in SA. But I still get the question, if a long short fund can start, means that they lose all my money. Isn't that violence on retail hedge funds?
So I think, first of all, is that retail investor regulations are very strict and rightly slow. So yes, you can short, but you either have to run limits in terms of individual positions and you run limits at net and exposure of the fund. And then there's also what's called a value at risk methodology, which basically takes what your portfolio is at any point in time, going back in history, how much is any of those positions moved against you. So if you've got a short position, you've got to go look at the worst since the history of that instrument. What is the worst period and how much you've lost by the share going up and short? And that has to put into a constraint of a 20% value at risk at fund level. So never mind an individual position level. So there are guardrails in place.
I think what's very nice about your fund, you've actually created solutions. They use the managers and how they look at risk management, all these factors, sort of factors. Solution. They're not sure about hedge funds. Like I said as well, there's a lot of good hedge funds out there, especially in say. You have to sort of come and think also around hedge funds. But if you look for a solution, Corion solutions, if you need to know more, please speak together.
Thank you, Jim. Thank you for your time.